When a bank reviews your business, they ask one question first. If something goes wrong, who absorbs the loss? Not the paperwork, not the idea, the loss. In the next 20 minutes, we're going to explore how banks actually evaluate your business structure. Now, imagine applying for a business loan tomorrow. You walk into the bank confident. You form the LLC. Paperwork is organized. The business has revenue. So, you assume the bank is going to review your projections and decide whether the opportunity looks promising enough to secure funding. But that's not the first question that the bank asks. The first question is much simpler. If something goes wrong, who absorbs the loss? Because banks don't evaluate businesses the way founders do. And in this episode, we're going to walk through how banks actually answer that question. Not the theory founders talk about, the process banks use when they review a business. We'll look at the documents they examine, the financial patterns they study, and the signals that lead a bank to conclude whether a business stands on its own or whether the owner is still carrying all the risk. Entrepreneurs evaluate opportunity. Banks evaluate risk. And the first risk that banks examine is structural. The first thing a bank reviews is not your projections. It's your formation and ownership documents, articles of organization, operating agreements, ownership disclosures. The bank studies these documents in order to answer a simple question. Who actually controls the company? If every decision authority points to one person, the bank immediately recognizes that the business may still depend entirely on the owner. When a bank reviews a business, it's trying to answer three basic questions. Can the business operate independently? Can the business absorb financial pressure? And if the business fails, who ultimately carries the loss? The bank can't rely on the owner's belief or intention. It has to rely on evidence. So they start collecting information. The first information the bank reviews is structural. Articles of organization or incorporation, operating agreements or bylaws, ownership disclosures, EIN documentation. At first glance, it looks like they're just going down a simple checklist. But they're not just confirming that the documents exist. They're studying the documents to see where authority lies. Who owns the business? Who controls the business? Who can bind the business to obligations? If a single individual owns and controls everything, the bank immediately understands something important. The business may exist legally, but operational authority is concentrated in one person. And that signals dependency. Not necessarily failure, but dependency. At this point, you may want to pause and think about your own business for a moment. If a bank reviewed your company tomorrow, what would they actually see? Not what you intended, and not what the paperwork says. What patterns would appear in the documents and financial activity? Next, the bank studies financial statements, tax returns, profit and loss statements, balance sheets, business bank statements. Again, the bank isn't just looking at revenue, it's studying patterns. Does the business generate stable cash flow? Does the business maintain reserves? Or does the owner regularly inject personal money to keep things stable? Those are the patterns that tell the bank whether the business survives independently or whether the owner repeatedly acts as a superhero. If the owner consistently rescues the business financially, the bank looks at the structure sideways. The entity exists, but the business appears financially dependent. Think about a house. A house may look strong from the outside: walls, roof, windows. But engineers don't judge the house by the walls. They examine the foundation. The foundation determines whether the house survives pressure. If the foundation is weak, the house may appear fine until a stress event occurs. Banks evaluate businesses the same way. The entity is just the visible structure. Financial behavior reveals the foundation. If the business already banks with the institution, the bank sees something even more revealing. That's like the backstage view. Cash flow patterns, deposits, transfers, payments. From here, the bank can see whether the business consistently operates on its own revenue or whether the owner regularly injects cash. Frequent owner transfers are a telltale sign of financial dependency, and irregular deposits signal instability. Consistent operating revenue signals independence. These patterns form the behavioral profile of the business. The bank also evaluates credit history, both business credit and personal credit. If the business has little credit history of its own, the bank makes the assumption that the owner's credit has historically supported the company. Again, this doesn't invalidate the entity, but it does signal that the business hasn't yet proven independence, which means the bank is going to protect itself. At this point, many founders recognize something surprising. Banks aren't evaluating the business the way entrepreneurs evaluate the business. Entrepreneurs ask whether the business works. Banks ask whether the business stands on its own. Those are very different questions. A business can operate successfully for years while still appearing structurally dependent. Once the bank forms an opinion about structural independence, it reacts by adjusting the loan terms. If the bank believes the business stands independently, the terms become more favorable. Lower interest rates, higher loan limits, longer repayment windows. But if the bank believes the business is owner dependent, the bank is going to protect itself. And the most common protection is the personal guarantee. A personal guarantee transfers the risk of failure back to the owner. If the business fails, the owner remains responsible. From the bank's perspective, this resolves the uncertainty. The bank no longer has to prove whether or not the structure works. It simply ensures that someone is going to absorb the loss. Think about an electrical circuit. A circuit breaker exists to stop dangerous electrical pressure from damaging the entire system. If the breaker works, the system survives the surge. If the breaker doesn't exist, the surge travels directly through the system. Structural insulation works the same way. If the business absorbs pressure independently, then the system holds. If the pressure travels directly to the owner, the circuit never existed. Banks observe this routing very carefully because lending money requires anticipating pressure before it actually arrives. If you're preparing to launch a business, this information gives you an advantage. Structure can be designed intentionally before exposure appears. Authority can be distributed. Financial stability can be built within the company itself. And if you're already operating a business, this episode becomes diagnostic. It helps you evaluate how institutions might interpret your current patterns. Because institutions rarely explain their conclusions. They simply adjust the terms. Banks aren't evaluating confidence. They're evaluating independence. They want to know whether the business can survive pressure without collapsing into the owner. If that independence appears clear, the lending becomes easier. If it doesn't, the bank quietly protects itself, often through personal guarantees, often through stricter loan terms, and often through declined credit. Understanding how banks evaluate structure reveals something many founders never see: the difference between a business that exists and a business that stands on its own.